and I'm going to explain everything on the illustration. Okay, so this guy is Oscar the Grouch. He was born 10/12/1968, so he just had a birthday. And let's say this guy at 56 comes in as an IUL lead and he wants to do maximum cash and low death benefit, right? So his main purpose of using the IUL is to grow his cash value so that he can supplement a tax-free retirement and be able to borrow from the policy. And the benefit, the other side of that would be, um, the extra bonus is the life insurance part of it, where he protects his family if he dies, and then he also gets the living benefits as well. Okay, so we're going to run it minimum death benefit, max cash value, and then he wants to pay monthly. And let's say that he wants to put in $1,000 a month. Okay. Now you guys know the rule of thumb, right? The rule of thumb is they need to put in on average, baseline 10 times their age. So if they're 20, they can put in 200. If they're 40, 400, 60, 600, right? That will give them enough cash value to start compounding over time and grow from there. Now, I'm going to just do a simple one, and they're going to pay monthly. There we go. And he's going to put in $1,000 a month. And he's 56 years old right now. And then we're going to show him what it would do if he paid in for 20 years. Okay. And then I'm going to hit the run button. Pop-up blocker. Okay, now I'm going to explain it to you guys just like I would explain it to a client. Okay. So I'm going to pretend you guys are a client on the other side of the phone. So first off, the name of the company is called National Life Group, and they're kind of out of all the 30 plus carriers that I have, they're the granddaddy of them all. They've been around for 175 years, since 1848. And they've actually paid claims to people that were on the Titanic. Pretty cool. This policy will address three major concerns for people that are living. One of them is, what happens if I die too soon? I bet that if you ask any of your friends that accumulated cancer, if you ask them if they knew they had cancer, they would probably all say, no, I didn't know until I went to the doctor, right? We have no idea what the future holds, right? So this addresses the situation of what if I die too soon? What's going to happen what happens to my family if they don't receive my income, my portion of the family income throughout the rest of their lives? Because our wives, our husbands, our family, our kids rely on our portion of the income to raise their family. What happens if I become ill? Back to the cancer thing. We never know what's going to accumulate over time. And if you were to accumulate cancer, that's a big deal. You have to go through treatment. That's time off of work. The doctor may say, well, you can still work, but hey, after treatment, you may not feel like going to work, right? So this will address that as well. And then here's a major concern about people that are getting ready for retirement, that are getting close to 60. Do I have enough money set aside to be able to live for the rest of my life and have money coming in? Or am I going to have to live with somebody or live in low income housing for the rest of my life, or the portion of my life that I'm older and I can't move and I need somebody to take care of me? So this is going to address those three things. And then based off of your monthly premium, it says I will start my policy by paying $1,000 a month. And what that does is at age 56, that will give you a death benefit of $345,000. So says if I die tomorrow, meaning that once you get approved and you make that first starting contribution payment, the next day you pass away, your beneficiary is going to get a is going to get a check for 345,269, and that is tax free. Okay. What happens if you need cash? Well, this is the type of cash that it's going to generate over time. And we'll get into the details on that here in a moment. NLG, this is their riders that they include in every policy. Well, not every policy, but most of them. If you're over 60, they don't include the Alzheimer's, but they're the only carrier that I know of that has the Alzheimer's rider. And what that means is, let me kind of explain this. This is based off of age 65. So if you were 60 when any of these happen, these numbers would be a little bit lower. If you were 70 with anything like this happen, these numbers would be a little bit higher. Okay. So let me kind of explain these. Terminal illness, NLG's definition. Well, let me back up. All the other carriers, not all the other carriers, but the majority of the other carriers, their definition of terminal illness is if the doctor says you're going to die in 12 months or less, you would get a benefit. Here with NLG, their definition is if you're going to die, if the doctor says you're going to pass away in 24 months or less, you would get a lump sum of almost 300,000. Chronic illness. This is your 6 daily living activities. If you can't perform just 2 of them for 90 days or more, you would get a monthly check of $5,054 a month until you can heal up and get back to work or get back to your daily living activities. Critical illness, this is your heart attack, stroke, kidney damage, liver damage, ALS, Huntington's, cancer. If you were critically ill, you would get up to 272,000 in a lump sum. Critical injury, this would be like say you got burnt by a fire, maybe you got a brain injury, maybe you get put into a coma. You would get up to a lump sum of 272,000. In Alzheimer's, they're calling this type 3 diabetes. Alzheimer's is prevalent these days and it's becoming more and more popular. Not really on a good note,
Popular.
but right. So Alzheimer's, if the doctor says you have Alzheimer's, you would get a lump sum of $258,000 based off of age 65. And then we scroll down here. These are the ratings. It shows right here that in the last year they paid out $6 billion in benefits. Okay, just a quick snapshot there. And then we scroll down here. This policy also comes with some extra riders that are free built into the policy, and you can definitely read over those once you get approved. And then right here, this kind of talks about the benefits a little bit more. Remember, I told you they're based off of age. Terminal illness, 296,000. Chronic illness, as the older you are, the more you get paid out. Alzheimer's, same thing. And then critical illness and critical injury, this is based on the impact of life expectancy. And what that means is, let's say you're 71 and you were to have a heart attack and they go in and instead of cracking your chest open, they just go in through your arm and they provide a stent, right through your arm, through a vein into your heart. They don't even crack your chest. You're probably going to go right back to work the next day with a stent in, be able to, breathe and move a lot better. You probably don't even need a benefit. But on the flip side of that, let's say you've acquired cancer and the doctor says, you have 10 years, probably approximately 5 to 10 years of life left. Well, you don't qualify for the terminal illness rider because that's 2 years or less, but your life expectancy is 10 years. So they're going to base this off of your impact of life expectancy. And at 71, you would probably get a benefit in between this amount right here. If you're 81, you would be in between this amount right here. Okay. Now we're going to scroll down here. And I'll show you the indexes. This is where the fun stuff begins. Okay. So here's the indexes right here. You've probably heard of the S&P 500. Yeah, we have that right here too. And we don't normally put our clients in the S&P as of right now, just because there's better performing indexes out there. As you can see, there's a cap of 9.25% with a participation rate of 105. So even though this is a good performing index, there are better ones out there. And what is a cap? Well, if the index did 13.62, as you can see in 2006, you would only get 9.25%. Okay, so that's just an example. What we like to do is put our clients in the US pace setter, point to point. And actually, NLG recommends this as well. And the reason why is there's no cap, right? So if the
So
market did
sorry,
80%, you would
sorry,
get 80%.
sorry to interrupt. Can I interrupt?
I suppose you already did.
Sorry. Oh, I didn't know. Sorry if this is being recorded too. I apologize. I thought this was in. I thought I thought this NLG was in the S&P 500.
No, NLG has the US pace setter. They also have the S&P 500 right here. But we use the US pace setter, and the reason why is because there's no cap, right? And there's a participation rate of 235%. Okay. So what does that mean? Well, let me explain these two columns here. This gray column are real numbers of what this index would have done 20 years ago. It's a 20-year look back to 2004. And then right here, this is real, the gray and white column, this is real numbers of what you would have been credited to your account should you would have had this IUL back then. So if you look, the index in 2004 did 12.67. There's no cap. It also has a 235% participation rate, which they just raised in January of this year from 225 to 235. So now you have an extra 10%. Now, what is that? Well, I like to call it a supercharger. And what that means is it answers the question, how much of my cash value is participating in this interest rate? So what you do is you take the interest rate and multiply it times 235%, and that's the crediting you would have to your account. So you take your cash value, multiply it by that, and that number is credited to your account. Okay. So just to kind of pick out some random numbers here, 2006, the index only did 7.13%, but you would have gotten almost 17% credited. In 2009, it did 4.41. You would have gotten 10% credited. 2013, it did -1. You wouldn't have lost any money. You would have kept all of your money. You would have flatlined that year. You wouldn't have gained anything. You wouldn't have lost anything, right? You don't gain anything because nobody else gained anything either. They all lost money though. You get to keep all of your money, okay? Here, the market is rebounding, as you can see, goes back up in 2014. You would have gotten 18.1. In 2016, did 3.23. You'd have gotten almost 8%. And then here's 2020, did fantastic. COVID has not kicked in yet. 14.75, you would have gotten almost 35% credited to your account. So if you have 100,000 in there, 35% is, 35 grand, right? But right here, COVID is kicked in and now the market dropped. The 21, you still got 7.81. But here's the thing that most of my clients that are getting ready to retire are afraid of. What happens if my 401k that I've worked my whole tail end off for in the last 10, 20, 30 years drops 15% right when I'm getting ready to retire? Well, if 15% of 100,000 is 15,000, and if you have, 200,000 in there, that's 30,000, right? If you have 500,000 in there, that's 75,000 that you would have lost just in the blink of an eye, right? Well, here you wouldn't have lost anything. You kept all your money. You had 500,000 of cash value in there. You would have kept all of it. Okay, so you'd have had peace of mind. You could sleep at night. So what's really important though is to point out the 5-year look back average, 10-year look back average, 15-year look back average, and you can see the lowest it did was a 10-year look back average because that includes, our COVID years. That's 12.6. And then all of 20 years includes COVID and everything else, and the average is 14.93. So I like to say usually you'll get anywhere between 12.5 to almost 15% on average, as you keep paying into it, right? And contributing to your policy. Now, what I'm going to show you here is based off of the maximum illustrated rate of 6.44%. Now, you say, Sean, well, they did on average 12 to 15%. Why are you only going to show me 6.44%? Well, two reasons. One of them, NLG's been around for 175 years. They don't need your money. They want your money. They don't need it. So they would rather under promise and over deliver. And on top of that, even though the current market may be 7-8%, which is I think it's right around there these days, again, they want to under promise and over deliver. So if you like the numbers at 6.44%, you're definitely going to like the numbers next year when they perform a lot better, right? So okay, we're going to scroll down here. We're going to talk about how you want to fund this, right? So what we're going to do here, and again, guys, this is exactly how I explain it to my clients, okay? We're going to spend a little time here on the guaranteed. We're going to spend a little time right down here on the alternative. And then we're going to spend most of our time right here on the current illustrated values, okay? So right back up here, guaranteed. What is guaranteed? Well, guaranteed means that they actually know what they can pay out according to the situation. Well, how do they know if nobody knows what the market's going to do in the next 10, 15, 20 years? Why? Because it's actually guaranteed. This is what they're guaranteeing you will get paid out. So in other words, they're not basing it off of what the market does. So what I like to call this is Armageddon. This is worst case scenario. My mom and dad always told me that if I need to make a tough decision and I didn't know what to do, think about what is worst case scenario. And if I can live with it, everything's going to be fine, right? So here, real quick, after 10 years paying $1,000 a month, you'd have 120,000 in there. And then you'd have about close to 65,000 of cash value based off of worst case scenario. You'd still have your death benefit, okay? So it's still better than a regular term policy, which you don't have any cash value. And you also still have the living benefits according to this death benefit that we just went over, okay? So now we're going to scroll down here. This is the alternative value, current value. State of Nebraska says that I need to show you something in between worst case and current illustrated value. So what they're saying here is if the market does exactly 3% every single year, this is what you would have. Same thing, you still have 120,000 going into it over the course of 10 years. You'd have 83,000 of cash value based off of just 3%, just 3%. Okay, now we're going to spend most of our time here. Now I want to get into these three columns so you can kind of completely understand what they mean. This is the death benefit. So that's pretty self-explanatory, right? If you die, your beneficiary, your family gets 345,000, and remember, that's tax-free. Okay, your accumulated value right here. This is the portion of the payment, the contribution payment that you make. That portion of it goes to the cash value side of things. Okay, the other portion goes to the cost of insurance, which gives you this death benefit. Now, if you were to think of a teeter-totter, right? One side's up, the other side's down, right? Well, we built this for you so that we can do max cash value, lower death benefit according to the IRS rules. Okay. So if you look, you're paying in 12,000 a year. pretty darn close to about 75% of your payment is going to the cash value accumulation. Okay, the other portion of the payment pays for your death benefit and your living benefits. It's the protection side of your payment. Okay, so the accumulated value is your cash value built into this. Now, the cash surrender value right here, this is the amount of cash value that you have to borrow from. Okay, and as you can see, they're not even the first 10 years. It evens out at year 11 right here. Okay, now why is that? Well, insurance companies have to make their money, right? So if you decide in year 5 that you've paid in, 12,000 a year till then, you still have 36,380 to borrow from. But if you decide to surrender the policy, they still haven't made their money back. So they're going to charge you a surrender fee. And that surrender fee is built into this number right here. So this is the amount of your cash value that's doing work for you, but this is the amount that you would get back if you were to surrender those charges. Now, once you surrender the policy, if you surrender the policy, you're going to be taxed as well on this 36,000 because it's not a loan, right? You're basically telling the insurance company, I have no intention to pay it back. I want to stop the policy, and all of my gains that I got would be taxed just like it would be in a 401k or an IRA, stocks, bonds, mutual funds. You're going to get taxed. Now, if you decide to keep the policy going and you start to use this and take out loans, you won't be taxed on the gains that you're going to take out. Now, as you can see, this is a long-term play, right? If you were to buy a house or use it as a rental property, an income producing property, you're not going to turn around and sell it a year later, 5 years down the road, and expect to pull cash out of there. It's not going to do that. It's a long-term play, right? And that's what you want to protect your family. The good thing about it is this is going to take care of you for the rest of your life. Okay, now as you can see here, after year 11, these numbers are even. So all the costs are irrelevant after year 10 because everything is even here. Okay, now if you look, you'd have 120,000 after year 10 and you still have 100,000 in cash value at year 10. Now, if you think about it this way, 120,000 minus 100,000, you've only paid in really about 20,000 because for the death benefit and the coverage, so really for 10 years worth of coverage, you've only paid in 20 grand. That's not really that bad, right? It's about 2 grand a year, which is less than, $200 a month, right? But here, let's play this out. If we look, by the time you're 75, you got 240,000 in here. And look right here, you have 325,000 of cash value. Cash value. And that is almost 100,000 more than what you've paid into the policy. This is only based off of a 6.44% interest rate. And what do we know about that? Two things. One, it's not going to stay at 6.44%. Number two, it's going to go up and it is going to go down. If it does go below zero, you get to keep all your money. That's the great thing about it. Now, what I want you to do, and this is what I do with my clients, is I tell them, or I ask them, do you have a calculator? And they'll say, yeah. And I'll say, okay, plug this number in. So let's do this, 325,680. And then what you do is you have them multiply that times 1.3, and that comes to 423,384.
Why
So
1.3? I've always been curious.
1.3 is because we don't know what tax bracket they're in. Okay.
Mhm.
And so average tax bracket is about 25%. So you have 25% tax bracket, you have a 5% federal tax bracket. So 25 plus 5 is 30%. So 1.3 would give you the number that they need to accumulate in a 401k or an IRA in order to have 325,680 after they pay their taxes.
Gotcha.
So let me say that again. So 325,680 times 1.3 is $423,384. Okay. And so they would have to accumulate that $423,384 in order to have this $325,000 after they pay their taxes. Now, some people are in a lower tax bracket. Some people are in a higher tax bracket. If you're talking to somebody that's wealthy, ask them what tax bracket they're in, and they'll probably tell you 37%. If they say 37%, add 5% on top of there for federal, that's 42%. Now you multiply that number times 42%, that's what they would have to have after taxes in their 401k. Okay. And so 25% is pretty average. If they're in a lower tax bracket and they know, just take their tax bracket and then add 5% to that for state, and then that's how much they would have. Okay. So let's play this out. You know, at age 80, you have almost $500,000. Right down here, 85, they got over $500,000, 609,000. And keep in mind, this is only 6.44%. Okay. And then age 55, or I'm sorry, age 110, 55 years into it, they got over $3 million. Now, I always get clients that say, and I tell my clients this, I always get clients that say, well, I'm not going to live that long, which is probably true. You may or may not live that long, but the carriers know something. And the reason why is because a lot of whole life policies used to only go to age 100.
100.
Yeah. Now they go to age 120. There is a lot of anti-aging stuff out there. And so if you live over 100, you definitely still want to be, you know, covered, whether that be 105, 110, 101, right? You still want to be covered. Now, to be honest with you, and I tell my clients this too, if I get to 100, I'm cashing out, baby. And I'll probably drain this thing and leave maybe $500 in here so I don't have to pay taxes on it. And I'm going to take it and run for the hills. Right?
Or it's actually quite a legacy to leave for.
Yeah, absolutely. Absolutely. Now, once we come down here, what I also like to let my clients know is that it is flexible, right? Here's your guideline level premium. This is your $1,000 a month. This is where you want to stay around every single month to keep this policy performing exactly like what the illustration does or better, right? But it is flexible. Let's say at the end of the year, you get a bonus from your job and you want to fund it and put it towards the cash value side of things, right? Because your cost of insurance is already determined, right? The carrier determines what it's going to be when they approve you, and they base it off of your age and your health, right? Now that'll go up just a tad bit every year, but it's not going to go up sporadically like crazy because they can only charge you so much for the cost of insurance. So the more you put into the policy, it goes to the cash value. Now you can put this amount in per year. You can do that for 7 years. It's called a MEC premium. It stands for Modified Endowment Contract. You don't have to remember that term. Just know that what that means is if you put over this number in per year, then the carrier is going to send you a check back because they don't want it to MEC. They want you to be safe and not have to pay taxes. What that means in a nutshell is that if you put in 50,000, what's going to happen is it's going to MEC, and it's going to turn into an investment and not a life insurance policy. And the IRS says, give me some tax money. Okay. Now, if let's say you have a rough month and 1 month out of the year, you know, maybe the wheels are falling off the car, you got some extra repairs and you need to downsize your payment. This is the minimum that you want to pay per year on your payment. Okay. So if you take that 5,147, I'll just do that real quick and divide that by 12, that comes to $428.90. So just call it $430. So if you have to downsize, for a month or so, just pay your 430, do that for a couple of months, whatever, and then bounce it back up. You can pay extra to catch it right back up, right? And so that's kind of how I explain the illustration. Then what I do is I just let them sit there and think about it for a little bit in, in silence. I won't say a word. And then I'll ask them, hey, the only thing that's left to do. Now, here's how I put it, right? I don't ask them the closing question right away. I frame it. And here's how I frame it. The only thing that's left to do is to submit a request to the carrier. Once we submit the request to the carrier, it's going to take about 2, possibly 6 weeks to get you approved. Now, if they're over 60, you need to let them know that they may require you to do a physical exam. Now, the way you let them know that, you need to make it sound like it's no big deal, right? And so the way you say that is, since this person's only 56, but let's say they're 65. Since you're 65, they're going to require you to do a physical exam, a blood draw, and just have you pee in a cup. Takes just a few minutes. They can even have somebody come out to your house if you really want them to, or maybe there's a facility down the street you can just run in real quick and get it done, right? So I just want to let you know that up front. Are you okay with that? Yeah, no problem, right? If you make it seem like it's no big deal, it is no big deal. It's all perspective, right? If you make it seem like, oh, you have to go get a physical exam, they're not going to want to do that, right? But if it's no big deal, it doesn't take much time, guess what? It's no big deal to them either. And they will actually call and schedule it. And you can even let them know that the company will call them and schedule the exam for them, okay? So the way I explain it is this. The next thing we need to do is just to submit a request to the carrier. And again, once we submit the request, it's going to take like 2 to 6 weeks to even get you approved. Everything is adjustable. Even once you get approved, I'll call you and ask you, are you good with everything? And if you are, then we just submit the request, and then you choose a date that you want the payment to come out, and then we kind of go from there. Okay? Yep. Now here's the closing question. Do you like the IUL? When they say yes, then I'm just going to assume the sale. Yes, I like the IUL. I think it's fantastic. Great. Let me get into the request form here, and then I go right back into it. I click the little green button, the iGo app. It'll kick me out because I haven't, done anything. It'll kick me out of the server for a minute, and then I'll log back in, and it'll take me right to the application, and I start filling out the application right there with them on my screen, seeing everything that I'm doing through Crankwheel.
You tell them what to expect? Because I thought we were to kind of prepare them that the kind of information that they're going to be asking, such as banking information and social.
Yep. Great question, Jeff. So as I'm logging into the application, right, they're seeing my screens change. I'm going in. Some of the first questions in the application are, agent questions, right? So as I'm filling out these agent questions here, that's when I let them know, what's going to happen, right? Because I want them to see that I'm getting into the application. Because if I start preparing them for what's coming before I get into the application, a lot of times they'll just say, because a lot of times if you're in the middle of doing something, people don't want to stop you, right? So if I'm in the application already, they can see it. I'm filling out questions, answering agent questions. Now I'm going to tell them, okay, I just want to let you know this is a life insurance product. So they have to invest in you. The carrier needs to think about you. Okay. They're the ones that are paying out $300,000 if something were to happen to you. Right. So they need to make sure that you're investable and that you're not going to die in a week after they approve you. They need to make a little bit of money. Right. And so do you. That's why we're doing this. That's why I love these, because it's a win-win situation. So how do they check you out? Well, they're going to ask you for your social. They use that. to check the MIB, Medical Information Bureau. Make sure that you're not going to die next week based off the prescriptions that you're on. They're going to ask you for your driver's license number to make sure that you are who you say you are. You're not taking out insurance in somebody else's name or running from the cops. That's not you, is it, Jeff? Nope, that's not me. And then towards the end of the request, they're going to ask you, if you do get approved, how do you want to pay for it? So they're going to ask you to put a financial institution or a credit union on file, like an account number, a routing number. That way, if you do get approved, it can just come out of your account. You don't have to worry about the policy lapsing. Okay? Okay. And that's how I explain it. All right there. Once I get into the application, that's when I explain what they're going to ask for. And most of the time, everybody already knows. Everybody assumes that since it's life insurance, they're going to ask for that, right? And when you put it to them that, you know, hey, the carrier needs to look at you. The carrier needs to qualify you. They're the ones paying out hundreds of thousands of dollars, if not millions of